Welcome to Deep Dive. We take your sources, break them down, and hopefully give you a clearer picture of the big stories in finance. Today, we're diving into retail, specifically looking at a real American staple that seems to have lost its footing lately, Target. You know, the S&P 500 has been soaring, lots of positive energy around AI, strong earnings. But then there's Target, TGT. It's just completely missing out. This was what retail people pointed to, right, as like a model for brick-and-mortar success. But the stock's been stuck in a pretty deep slump for a couple of years now. So our mission today, unpack the sources, figure out why Target's struggling when competitors seem okay, see how bad it's gotten, and importantly, what management's trying to do about it over the next, say, 3 years, and what does that mean for you?
And we really need to start with just the scale of this because it's pretty staggering. The sources point out Target stock is down, 65% from its peak just 4 years back? That's a huge drop in value. And crucially, this isn't just the whole sector tanking. You look at rivals like Walmart, Costco, they're actually doing pretty well, adapting, posting solid numbers. So Target is the real outlier here, which immediately tells you the problems are probably specific to Target, or they're facing structural issues hitting them harder.
Okay, let's tackle that first. Why Target? Why is it getting hit so uniquely hard right now when others selling, similar stuff are doing okay? Is it just bad execution, or is there something fundamental about their model that's just wrong for this moment?
Well, the sources argue it's largely structural, and it's really amplified by the current economy. Target built its whole identity, its brand around discretionary items.
Right, the Target run, where you go in for toothpaste and come out with $100 of stuff you didn't know you needed.
Exactly. It's the cheap chic, the seasonal decor, trendy clothes, nice housewares. It's meant to be, a fun place to find bargains on non-essentials. The sources label this a reliance on discretionary products. That's their sweet spot. Now, contrast that with, say, Walmart or Costco. Their whole image is built around groceries, essentials, the basics.
Necessities.
Necessities, exactly. So what happens when inflation stays high for a long time and you, the shopper, have to watch every dollar?
You still go to the store.
You still go, but you shift your focus, right? You have to buy food, maybe medicine, paper towels. You don't have to buy that cute throw pillow or the new top.
So Target's kind of being punished for being the fun store.
Yeah.
When people walk in, it reminds them of splurges they can't make, while Walmart just has the stuff they need to buy anyway.
That's the argument, yeah. That core setup, the heavy lean on discretionary spending, it becomes a massive disadvantage when consumer confidence is low and budgets are tight. People cut the fun impulse buys first. And that's Target's bread and butter, traditionally. That really sets the stage for, well, everything else that followed.
Right. And speaking of things going wrong, it sounds like the economy was only part of it. What operational problems, what internal issues made this worse? The sources call it a perfect storm.
Oh, it absolutely was a perfect storm operationally. Remember the supply chain chaos during and after the pandemic?
Yeah, nightmare.
Well, Target, like a lot of retailers, seemed to misread demand signals coming out of that. They ended up massively overstocked.
With the wrong stuff, presumably.
Exactly. Mountains of unwanted inventory, specifically those discretionary items we just talked about, just sitting there. So to clear that out, they had no choice but to slash prices. Huge, costly markdowns.
Which kills your margins.
Instantly. If you bought something for $10 and sell it for $5, that's a direct hit. Plus, on top of that, you've got rising general costs, labor, shipping, everything, and then more recently, various trade tariffs adding pressure.
Wow. So paying more to get things, having too much of the wrong things and selling them cheap, that's not a winning formula.
Not at all. And then there's another layer, which affects investor confidence. We should mention the factor the sources flagged regarding Target's political messaging.
Okay, and just to be clear for everyone listening, we're reporting this impartially as a factor the sources raised, not taking any side.
Absolutely. The point is that Target got involved in some messaging and product choices at different times that angered significant groups of consumers, reportedly on both sides of the political aisle. And when you're analyzing why investors might be nervous or why foot traffic might dip, the sources suggest this kind of controversy just adds another layer of risk and instability. It's another headwind, potentially self-inflicted.
That is a really tough mix of problems. And the recent numbers definitely show the impact, right? Let's look at that fiscal Q2 2025, ending in August. Comp sales fell 1.9%.
1.9%. And for a retailer Target size, any negative comp is worrying, especially when rivals are flat or growing. It signals they're losing share. But maybe even more telling is the operating income, down over 19% year over year.
Wow.
That really shows you how much those markdowns, the higher costs, the tariffs, how much that's eating into the actual profit from selling goods.
So things are definitely looking rough overall. But the forces also hint at some maybe green shoots,
Yeah.
signs of internal progress, even with the bad headlines.
Yeah, and this is where the story gets a bit more complex because it's not all bad news internally. While the big picture is pressured, they have actually managed some significant wins, especially in how they're serving customers.
Like what?
Well, the digital side is surprisingly strong. Digital comps, so sales online, were actually up 4.3% year over year.
Okay, that's interesting.
It suggests people still like Target stuff, the brand loyalty is there, even if they aren't physically visiting stores as much. And maybe even more impressive, their convenience game is improving. Same-day delivery services jumped 25% year over year.
25%.
Yeah, which shows they're getting better operationally at using their stores almost like mini distribution hubs. Getting faster, more convenient, that's a real operational plus.
Okay, wait, let me push back on that a bit for the listener. If digital is up 4.3%, but overall comps are down 1.9%, doesn't that just mean the physical stores are bleeding sales even faster? Is that really progress or just, managing the decline slightly better online?
That's a very fair question, and it really highlights the core challenge, right? The digital gains are helping, they're slowing the overall bleed, but they aren't yet fixing that fundamental problem of falling demand for discretionary items in stores. However, the sources do also note that physical store comps, while still negative, did get better between Q1 and Q2, like more than 2 percentage points better.
Okay, so the rate of decline in stores slowed down a bit.
Exactly. They seem to be stabilizing things, slowing the negative momentum. The operational improvements, like delivery, are clearly helping customer experience, even if the top-line revenue is still under pressure from the economy.
So they can execute on strategy, but the broader economic headwinds are just too strong right now. Which brings us to the future. What's the plan? What levers are management pulling to try and steer this ship back on course over the next few years?
It's definitely a multi-pronged approach, heavily focused on efficiency and cost savings, at least initially. They're putting serious money into tech, particularly artificial intelligence AI applications.
AI, okay. Everyone's talking AI. But what does that mean for Target specifically?
Well, the sources say they're using it for very concrete things, improving supply chain management, trying not to repeat those overstocking disasters, and optimizing inventory, like using AI to predict exactly what to stock, where, and when. The goal is just smoother, faster, cheaper operations.
And efficiency usually means looking at headcount too, I imagine.
Precisely. They're doing a significant restructuring of teams and roles. That included announcing 1,800 job cuts.
Oof.
Yeah, it signals real urgency. It was apparently one of the first big moves announced by the incoming CEO, showing cost control is top of mind. They're also still expanding stores, but seem to be focusing more on smaller formats now.
Okay, and what about trying to get people excited about shopping there again?
Right, that's the other piece. They're trying to bring that Target flair back, even into essentials. It's this initiative called Fun 101. The idea is, okay, people need groceries, so let's make our food and beverage offerings more stylish, more uniquely Target. Maybe you'll pay a little extra for the Target-branded snack or the cool kitchen gadget because it has that design edge, trying to inject fun back into the necessary purchases.
Interesting. And all this is happening with a new person at the helm. We've got incoming CEO Michael Fidelk. He's a Target lifer, right? 20 years with the company. How's the market taken that? Is he seen as a steady hand or maybe part of the old guard that needs shaking up?
Well, the market reaction seems to have been pretty lukewarm, honestly. Which is a bit concerning. Investors were already doubtful after the Q2 numbers, wondering if the turnaround plan could work without the economy really helping out. And facing that 65% stock drop, you heard chatter that maybe they needed a fresh perspective.
Someone from outside.
Yeah, exactly. Someone to come in and make potentially disruptive changes rather than an internal veteran. So the sources suggest the market hasn't fully bought into Fidelk yet. His being untested in that top job just adds another layer of uncertainty.
Okay, so here we are, a business down 65%, betting on an economic recovery and an internal CEO facing real skepticism. What's the takeaway for you, the listener? Is this a bargain waiting to happen or maybe a value trap? The sources seem pretty clear. The next 3 years really depend on things outside Target's control changing.
That's the core issue, that structural problem with discretionary spending. It's like a weight they're dragging. It probably won't lift until inflation really cools off and people feel comfortable splurging again. So management can set goals for growth, but right now they're just goals. The profits aren't there to back it up yet. They really do need the macro environment to shift.
But there's another piece to this puzzle, right? The dividend.
Ah, yes. And this is where the tension really becomes clear, especially for income investors. Target has an absolutely extraordinary dividend history.
Tell us about that.
It's an elite dividend king. That's a rare title. It means they've raised their dividend payout every single year for, wait for it, 54 years straight.
It's 54 years through everything.
Through recessions, crashes, you name it. And even now, with all these struggles, they've committed to keeping that streak alive. Right now, the stock yield's about 4.9%. That's quite high. So for a long-term income investor, probably the safest bet you can make about Target over the next few years is that they will likely raise that dividend again, even if it's just by a tiny amount, to keep the king status.
So you get this interesting mix. A high yield right now, potential for growth if the turnaround works, and this bedrock reliability from the dividend history.
Exactly. It's a real study in contrasts. A high yield, potential upside, and that track record.
That sums up the friction perfectly. You've got this huge retailer, stock hammered down 65%, leadership questions, facing major economic headwinds. But underneath, it's still operationally capable, making real progress in digital, and crucially, defending one of the most impressive dividend streaks anywhere.
And, that commitment to the dividend, that 54-year streak, even while operating income is falling and they're cutting jobs, it shows a real dedication to income investors. Maybe it signals internal confidence that they will recover. But it also raises a really fascinating question for you to think about. Is sticking to that dividend king status, no matter what, the right move? Is it a sign of confidence? Or is it maybe prioritizing history, that corporate identity, over potentially redirecting that cash to fix the business faster? Legacy versus financial reality. That's the balancing act they're facing.